There are more and more signs that we may be on the precipice of another major financial crisis. The former CEO of the Wall Street bank Goldman Sachs warned in an interview on Bloomberg that he can smell another financial crisis on the horizon. Now, where exactly could this crisis come from? Well, some financial analysts are worried about the private credit industry in the US, which has exploded in recent years because after the 2008 crash, banks were more heavily regulated. So more and more firms on Wall Street began to lend to private companies, and the private credit industry ballooned. It is now a $3 trillion industry, yet it is not regulated. And many of these private credit firms have given bad loans to bad companies that are now defaulting. We published a short video explaining the issue with the private credit industry and the fears of a new financial crisis. However, that video is just a brief introduction to the problem. I thought it would be important to go into further detail explaining the very real danger here. And I thought the perfect guest to interview to help us understand this would be the economist Michael Hudson. Michael is the author of many books, including Killing the Host, How Financial Parasites and Debt Destroy the Global Economy. So here we're going to play some highlights of our interview, and then we'll go straight to the discussion.
You then begin to have private capital take over companies and make money by essentially looting them. Thames Water in England is typical of how you loot a company. Hospitals, for instance, were a target of these private equity companies. Private equity proceeded to bankrupt whole swaths of the American economy, and a new word was added to the English language, enshittification. Just cutting back the quality of what companies were doing, slashing expenses, working labor harder, making them work overtime. So the financial system has been turned into a predatory system, and all of this enormous growth in financial wealth since 2009 has accrued to the financial and real estate sector, to the dominated by the wealthiest 10% of the population. The 40% of the American population doesn't have any savings at all. They're living on the brink. And now that the costs are going up, they're having to fall further and further behind on their credit card debt, their personal debt, their automobile debt, student loans especially. But as long as the credit card companies will lend the consumers the money to the credit to remain current on their obligations and not have to pay penalty fees, then you're going to be able to keep the Ponzi scheme going. A Ponzi scheme is you need more and more money paid into it to keep the exponential growth rate growing.
Michael, thanks for joining us today. It's always a pleasure having you. Let's talk about the real possibility of a new financial crisis. If you read financial media outlets like Bloomberg and the Financial Times, they have been warning a lot recently of the possibility of a new financial crisis. And it could potentially start in the private credit industry, which is seeing all of these problems and rising default rates. And it could spread. This could be contagion that spreads to the banking sector and other industries. And then you also have the AI bubble and the war in Iran and the energy shock. There's so much we're going to talk about today, but let's just start by talking about this crisis. Do you think we could be on the verge of another major financial crash?
Yes, the whole problem stems exactly from 2008, or more particularly 2009, when President Obama took office, and his solution to the junk mortgage crisis, the bank fraud crisis, was to turn the economy into a Ponzi scheme. That was, he needed to bail out the banks. The banks had made so many fraudulent and bad loans that exceeded the ability of these banks to collect on their high interest junk mortgages that had been given, that major banking companies were in negative equity. What was the solution? The solution was a zero interest rate policy, ZIRP. The Federal Reserve lowered interest rates from the high crisis levels in 2008 and 9 way down to 0.1%, which is what banks could borrow for. And the Federal Reserve was able to create electronic money on its computers to lend to the banks at a very low interest rates, and said, well, banks, you have as much money as you want at 0.1% that we are providing you to lend out to the economy to support the price of real estate, stocks, and bonds, so that we will restore the negative equity that the reckless banking sector has created. Well, the result is that the banks did two things. One, they could simply leave the 0.1% money they borrowed with the Federal Reserve, make a few percentage points for nothing in their sleep by just leaving it with the Federal Reserve, because the Federal Reserve said, our job is to transfer money from the private economy into the banking sector to rescue the financial sector, because that's what central banks do. We represent the commercial banks. So we're going to begin paying interest on the bank reserves that never did, the Fed hadn't done before. But all the rest of the money, we want you to lend out to the economy to you make as much interest rate margin, the increase in what you charge to borrowers over what you can borrow, the cost of your borrowing from us, that's almost nothing. Well, the banks weren't set up to evaluate loans to, particular companies specifically. The banks usually make money on collateral being pledged for their loans. The bank credit isn't extended in the United States or Britain to finance industrial capital investment. That's the job of the stock market, if anything, or of companies to reinvest their earnings. Banks lend money for assets, real estate, stocks, and bonds already issued, already in existence. So they lent money out to near intermediaries, saying, you do the job of, you find the companies to take over. You then begin to have private capital take over companies and make money by essentially looting them. Thames Water in England is typical of how you loot a company. Hospitals, for instance, were a target of these private equity companies. They would go to a hospital saying, well, sell off your real estate to a separate entity, and then you agree to use the capital gains, the money that you make selling the real estate, pay a special dividend, and now instead of owning the real estate, you will now be paying rent on a long-term lease for the real estate. And we'll lend you the money for this, and you'll be paying us credit, management fees, late fee penalties. And the result is that a lot of hospitals went bankrupt. The private equity proceeded to bankrupt whole swaths of the American economy, and a new word was added to the English language: enshittification. Just cutting back the quality of what companies were doing, slashing expenses, working labor harder, making them work overtime, cutting when there was an attrition of the labor force. When workers left, you let the remaining workers pick up all of the slack. Productivity went up. So you had an extractive, predatory financial system in the United States. Well, meanwhile, this predatory financial system was making so many gains for the companies that were financialized and using their profits not to invest in new capital formation and new factories and means of production. All that was done abroad. It was sent to China and other Asian countries. 94%, 92 to 94% of corporate cash flow, profits, and all the surplus they had was spent either on dividend payouts or buying their own stocks. So you had companies creating the stock market boom by buying their own stocks back to push up the price so that the earnings they had would be spread over a shrinking and shrinking number of shares, making the illusion of increasing earnings per share. The earnings weren't really earned. When you make money in your sleep, it's not earned. It's economic rent, meaning unearned capital that you make in predatory ways. So the financial system has been turned into a predatory system, and all of this enormous growth in financial wealth since 2009 has accrued to the financial and real estate sector, to the dominated by the wealthiest 10% of the population. The 40% of the American population doesn't have any savings at all. They're living on the brink. And now that the costs are going up, they're having to fall further and further behind on their credit card debt, their personal debt, their automobile debt, student loans especially. So they're not able to pay. And the bottom 60 to 80% finds it's hardly increased at all. What used to be the middle class isn't really in the middle anymore. This turns out the middle class people are wage earners, just like the blue collar earners. They all have to pay rising costs for either for rent or for their mortgages to buy homes that are whose price is inflated by the low interest rates that enable a larger and larger debt to be created on the basis of these low interest rates. Well, now that interest rates are going up, you can imagine the cost squeeze. There's a huge wave of defaults happening all the way from consumers, the polite word for wage earners in America, to corporations that are being squeezed. And so this is all part of the backwash that being a Ponzi scheme, essentially the way that you enable the economy to keep paying its debts is you lend the debtor the money to pay the interest. That's what credit card holders do. They will send in the monthly payments due on their credit cards, and their credit card debt is going to go up and up and up, and with it, their monthly payments. But as long as the credit card companies will lend the consumers the money to the credit to remain current on their obligations and not have to pay penalty fees, then you're going to be able to keep the Ponzi scheme going. A Ponzi scheme is you need more and more money paid into it to keep the exponential growth rate growing. The same thing happens for corporations. As corporate sales fall off, as labor is squeezed, if in the United States wage earners have to spend more money on gasoline, on electricity prices that are going up, partly as a result of gas prices, on all of these monopolized expenses, then they're going to have less and less money to spend on the goods that they produce. And that means that companies that produce goods and services for sale in the United States are going to have lower sales and lower profits out of which to pay the rising debts and the interest on their carrying charges that they are mounting up and that are being increased as the economy is pushed into financial crisis as a result of the move to a war economy. It means that there are going to be layoffs, that companies are going to be closing down. Farmers cannot afford to do farming anymore. Chemical companies cannot afford to produce what they were producing before. Electric companies cannot afford to pay the higher prices for their gas or oil without regulatory agencies increasing their electric rates. They're going to be, and that means that firms using electricity are going to have to close down their offices. We're in for the equivalent of what was the Great Depression. And depressions are not inflationary. They're deflationary. That's what nobody seems to get. They think, oh, if interest rates go up, then wealthy people who have a bond are not going to be able to buy as many goods and services as they could. And we have to stabilize their purchasing power of their credit by lowering the purchasing power of labor. The economy is to be sacrificed to the financial sector. That's what neoliberalism is all about. That's what finance capitalism is all about, and make it so different from industrial capitalism. We're in a post-industrial society, and that's a financial society run by the banks through their control of the central banks, which are controlled by the government, that is whose campaign is financed by contributors from the finance and the real estate sector. So it's all sort of a self-feeding circular flow, and Ponzi schemes always end in a crash. That's what's leading other investors to try to withdraw from the American and European economies. But where can they withdraw to? That's the problem. What can they do?
Well, I think that's a great note to end on, Michael. Of course, as we see more developments on Wall Street and potentially more crises, we definitely will have you back to help us understand everything that's happening. It's always a pleasure. Thanks for joining us.
Well, thanks. I think it's going to be evolving rapidly, month by month, and almost week by week from here on in.